I think this Genius Act, the stablecoin bill, is one of the most dramatic pieces of bank regulation in U.S. history. I call it the third most important.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to this episode of The Bull of Wall Street. My name's Tally Leger. I'm the Chief Market Strategist at the Wealth Consulting Group, and I'm joined by my co-host and good friend Jim Warden, our CIO. And this time we have our honorable guest, Jan VanEck, the CEO of VanEck, the $130 billion asset manager. And Jan, I know you're a passionate podcaster, so welcome to the show.
Thank you. It's always fun.
Yeah. Well, I'm sorry that our CEO, Jimmy Lee, couldn't make it. I was joking about some podcast karaoke. He's actually in South Korea, and he might even be in a Noribong. It's 3 a.m., but we thought it was a little bit aggressive for this episode.
I think that's generous of you. It's the summer anyway, right?
Yeah.
Yeah.
Well, let's get down to it. Jan, I'm a fan. I actually personally own your semiconductor ETF, which has served me well since the April lows. So thank you for that. And Jim, I wanted to ask what VanEck products does WCG hold in our model portfolios?
Yeah, so we own Angel, the high yield ETF. Been super happy with that. It's different than some of the other high yield ETFs, and so happy certainly with that. We've looked at some of the other ones, and some of them aren't quite approved yet at LPL, but like hopefully those will be ready for us to invest in as well.
Well, those are two of our greatest hits, but happy to talk about whatever you'd like.
Yeah. Well, so let's go from there. So maybe tell us some things that our advisors, that's basically our audience here today, may not know about you, Jan, like your journey from macro to crypto.
Yeah, I mean, I'd love to just give a little bit of background on VanEck and our investment philosophy. We're just celebrating our 70th anniversary. We were founded in 1955. And we've always been a firm that's basically been looking around the world for big macro, economic, political, or technological trends, and then trying to have a conversation with advisors and with end investors about what might be additive to their portfolios. So, my dad made his name by starting the first gold fund in the United States when gold was pegged at $35 an ounce. Obviously, that fund did extremely well when gold went up to $800 an ounce. And so we're basically looking for other kinds of trends like that today. I would say off the top of my head, number one is obviously AI and the impact on corporate profitability. That's not unique there, but semiconductors has been a great way to play it. In no particular order, number two, the federal budget deficit. Again, big macro issue, but it's been propelling gold and Bitcoin this year and over the last 2.5 years. And then my big international trend that I like to point out is the rise of India. India has got sort of all the macro momentum that you would like, and they did a lot of pro-business reforms, kind of several years ago under Modi. I wanted to say Mamdani, who was our mayoral candidate. Got to slap myself on that one. And, in 10 years, India is projected to be the fourth largest consumer market in the world. So it'll be the US, Europe, China, and India. And it really helps companies get a global competitive edge and a cost advantage if they can be sort of incubated, if you will, in the large domestic consumer market. So anyway, those are some of the trends that are top of mind that we're talking to clients about.
That's great. No, of course, we can't talk about performance and tickers, but is there a particular vehicle that you like for expressing that India theme?
We have a couple of solutions. I would say the dynamics of India are basically a deregulation, and then number two, joined with a very important thing, which is basically the cost of mobile phones fell so hard that basically almost everyone in India can afford one. So everyone is on a digital platform. They have a free digital payment system that's national and a digital identity system. And so the example I like to give is during COVID, they basically said you could open a brokerage account without needing physical identity papers. You could use the national ID. And that stimulated, like there's one brokerage firm alone that was opening 1 million accounts a month.
Oh, wow.
Even large by LPL standards, right?
That's huge.
That's now those account values are probably pretty small, several $100s, but they're getting that system. And then actually the other thing I'd like to point out about India is that the returns of the Indian market over the last 5, 10, 20 years are very comparable to the S&P. When you hear emerging markets, it's not a question of whether you run away, it's how fast you run away, right? But India has actually been an exception to that. And I think that shows what a pro-business environment, a pro-equity environment can be in a country.
Yeah, well, selectivity, I think, has always been key in emerging markets. And I appreciate that, having been the global equity strategist at Oppenheimer Funds and in Invesco. So I hear you. On one of the other themes there, you were talking about gold, and that resonates especially now. Jim, didn't we consider ounce in our liquid alternatives sleeve?
Yeah, I think that was something that we're looking at in terms of how do we get in different models that are in different custodians, and so but yeah, certainly looking at that along with GLD, this. So I guess, Jan, I've got one question going back, if you don't mind, to Asia. So you mentioned India. Where do you kind of see the rest of Asia? In terms of China, I mean, they're doing some amazing things technologically. I feel like, especially with electric vehicles, and maybe not quite there with autonomous, but what are your thoughts on China and Japan? I saw Japan actually did the first transaction or working on the first transaction of a building all on blockchain. So that sounds super fascinating. I don't understand all of the, ins and outs of blockchain and how that works, but I know that it removes a lot of middlemen.
Yeah. Well, China is very interesting. I just spent 2 full days last week with some Chinese economists out of Shanghai's Jiao Tong University. I would say it's been a depressed environment for equity investors, right? Because of the over-competition situation with many industries, really with every province wanting to get its hand in the game and having their own AI compute center, technology center, EV manufacturer, whatever it might be. The question is, will that turn around anytime soon and reward equity investors? I'm not so sure it's going to be a super pro equity climate anytime soon. I wouldn't be underweight. But on the fixed income side, it's actually potentially more interesting. So listen, we never know what the future is going to be, but there is a scenario which I think is underappreciated where there's a big trade deal between the US and China. And the unlock is really not probably that China opens itself up widely to foreign competitors, but that the Chinese consumer is kind of a little bit more unleashed. I mean, effectively, because of the Shanghai lockdowns, because of the property depression, Chinese economies, consumers have been doing nothing but putting their money in the banks. The amount of cash in Chinese banks is astounding. And so Scott Bessent, our Secretary of the Treasury, has been talking about maybe some kind of unlock. Now, added to that, you could actually see, and probably should see, an appreciation of the renminbi, which would be very good for our terms of trade, right? We would be having, more exports to China. China would be a bigger consumer around the world with a stronger currency. So that's scenario. And one of my colleagues can see a doubling of the value of their currency over a 5-year period. I'll just put that out there as a thought experiment. So it's no one knows. We could just be stuck in the status quo for a long period of time, but it's something that should be on people's radar screens as a possibility, and to kind of reposition.
Wow. Now, how about the blockchain and the real estate?
So blockchain, sorry, yeah.
No, you're good.
I don't know about Japan and blockchain per se, but I think this Genius Act, the stablecoin bill, is one of the most dramatic pieces of bank regulation in U.S. history. I call it the third most important. We got Alexander Hamilton. We got FDR's reforms in the 33 by putting in deposit insurance and trying to make banks so that they don't blow up. And stablecoins bill, what it does is it allows technology companies or anyone to compete against the banks in terms of the payments infrastructure in the United States. Everything in our lives, right? I call it the bank account is like first base. You have to touch first base to do anything. My personal financial life is centered around my bank account, right? I didn't change it since college because they have everything, all the information.
Yeah.
And the stablecoin bill is really allowing some very powerful companies with hundreds of millions of consumers to compete. So I think, when I look at blockchain, that, now obviously Circle, the stablecoin companies, rallied dramatically since its IPO over the last 2 months. Ethereum and Solana, which are likely to be used heavily by stablecoin companies, have rallied dramatically. So we'll see how it plays out. So not sure about real estate in Japan. But I think there's a lot. And actually going back to China as well, a bunch of Chinese companies have been using blockchain, crypto, whatever you want to call it. There's basically a huge offshore financial system that's been involved out, in China. Binance, their biggest exchange, offshore exchange, has 350 million customers.
Oh, wow.
So a lot of that's offshore Chinese money. Anyway, what does that really mean for the rest of us? If you own the S&P 500, there are companies in there that are potentially going to widen their margins by using stable coins. And there are some, like the banks and the credit card companies, that could see a little pressure.
Hey, can I just jump in there, Jim? I got a question. We went scattershot. I just want to go sniper because these are big issues. I think we have 45 minutes, so we can pause a little bit. So a question I had for you was on the international theme. So I'm sensing a strong preference for international over domestic equities, and I've been there. Jim and I talk about this all the time, but I wanted to ask you about the kind of flip side of the same coin you were talking about with renminbi. So the U.S. dollar has been weakening year to date pretty sharply, and that's been a nice tailwind for U.S.-based investors. And when I look at things like the CFTC futures positioning, particularly the speculators, we are net short, but it doesn't really seem excessively so. So I'm wondering, do you think it's kind of a little bit too soon to expect a kind of counter trend rally in the U.S. currency? What are your thoughts there?
I just feel that, I'm not so short-term oriented. I just feel like there's this long, decades-long gravitational pull away from the dollar. And so when I was talking about like the rise of India, it's not like a negative thing for the dollar per se, but the Chinese and the Indians have absolutely no interest in having the dollar be part of their economic ecosystem. And so the role of the dollar will just be declining. And then secondly, I do think the rest of the world looks at some of our policies, whether it was the seizure of Russian reserves after Ukraine, or some of our tariff policies, as just a less predictable maybe ally. And that has just led for this ongoing bid for gold bullion from central banks, but also from the private sector. So I think this sort of de-dollarization is going to be a tailwind for investing overseas. I can't tell you that the immediate impacts of that. That's pretty hard. I mean, people could say interest rates in the U.S. are bound to fall sooner or later, and that would make the dollar less attractive. But I think GDP growth is actually a better intermediate term indicator, and we're slowing a little bit, but nothing so bad relative to the rest of the world.
You raise a good point, especially with rate differentials, because there's a huge divergence between, the U.S. policy rate and others, and the dollar has been going down in the face of a higher policy rate. So I think that resonates there. But you started to talk about U.S. plays, sectors. If we do believe, and I tend to agree with the U.S. dollar weakness thesis. I mean, our foreign counterparties, including central banks, have been diversifying away from the dollar for years. That's not a new trend, in fact. But what would be a couple of sectors that you would point to for U.S.-based investors if they didn't necessarily want to buy, India or China?
I mean, I guess it really comes down to, I would say international is probably going to matter a little bit less than AI. I'm very curious as to how this quarter's earnings plays out in terms of the profitability. I don't know if you know this firm called Coatue, but they had a chart in their investor deck about a month ago that showed how Microsoft's employee headcount, and there was actually just an article in the journal today, I think, about this, where some of the large cap companies' headcount have flattened, but their revenue is growing, which is just like a dream world for equity investors, right? Because margins are expanding, profitability is growing. So I think the question is, will that affect large caps more than small caps? And I kind of have to think yes. I hate to lean back into the S&P 500, but I kind of feel like that's where it's going right now. If you don't, the example I use is, VanEck has about 500 people globally. We don't have a lot of people doing the same task. It's very hard to use AI, when maybe there's 2 people or 3 people doing the same task. But if you talk like a CEO of a big bank, they don't have 2 people, they don't have 20, they don't have 200, they have like 2,000 people doing the same task. That is prime for efficiency methods and AI, since a lot of that's moving data around, right? So, that would benefit the large caps again. So not maybe dramatically disproportionate against the smalls, but yeah, I mean, it's just, I hate to be the person defending the multiples of the S&P 500, but and a year ago, honestly, I was pretty negative on NVIDIA when it was selling at 50 times revenue. But I find it hard. I don't feel like we're at some kind of extreme here. It's really the fundamentals could be coming through, in a way that's an equity investor's dream.
Well, you're not alone. We sympathize in our mid-year outlook. In fact, we wrote about those very themes. If you look at the margins across the 11 sectors of the S&P, as an example, it's dominated by fintech companies or tech adjacent companies. And if you look at the sectors that are citing AI the highest frequency is amongst the same sectors. And I don't think it's a coincidence. So I think we're we're on the same page there. Jim, you had an interesting question earlier about one of those ETF concepts. What was that issue you were going to raise?
I don't remember exactly, but I was going to ask Jan about AI because we're really, really, interested in that, looking at it. We own a lot of those names. Even we own a little bit of quantum and some of the energy names that kind of play into AI, utilities, nuclear. Some of those have done extremely well. We're really, really happy with it. But I was going to ask you about, aside from productivity, do you see AI helping on the revenue side in terms of like increasing it? Because I feel like we're starting to see a little bit of that more, the revenue can increase. I mean, if you can reduce your cost at the same time boost your revenues, that seems to be, kind of the perfect Goldilocks scenario, I guess.
Yeah. Well, I mean, obviously, the suppliers to the industry, like the semiconductor companies, right, have explosive revenue, and then all the ancillary. To your point, I would call it we call it at VanEck like the phase 2 beneficiaries of this trend,
Sure.
right? So it's the demand for infrastructure. So yeah, we have a diversified nuclear ETF that's been benefiting tremendously. We have some natural gas companies, right? Because in the intermediate run, it takes a while to get nuclear up and running. Natural gas will be a beneficiary. So yeah, we're definitely 100% into that theme. I mean, valuations are pretty rich right now, but it's hard to know because, like, with nuclear, the counter was coming into the year is that, we've seen this before, alternative energy, right, solutions that take 5 years to become profitable, and we got destroyed in wind and solar, right?
Yeah.
And that was the risk with nuclear. But on the other side, it's just a global trend, and there are so many projects going that these companies have. They posted good earnings in the second quarter. It's just kind of amazing. So I think and then you had this huge push from the administration. So, I mean, I think it's almost an issue at the top of national security where we need to get our energy production going. I heard our president, talking over the weekend that he wants to have as much addition to energy capacity by the end of his administration as China, which would just be, I mean,
wow.
even if it's a stretch goal, as they say,
Sure.
It shows you the direction of momentum. And it's funny. I was just having, lunch with some of our summer interns, and the IT intern was just saying about how much compute he's adding to, one of our colleagues that's doing a lot of AI. So, sorry, long-winded way of not answering the question about revenue, but still.
No, I love it. I love it.
Well, I can add on to your thoughts there on revenue, because we dug into that subject as well. It could actually be kind of virtuous and self-reinforcing if more and more companies are using AI to boost their efficiency and productivity. That could be a huge tailwind for aggregate GDP, and that's a major driver for the top line of all S&P 500 companies. And if that happens, it's kind of like the rising tide that lifts all boats, maybe even select small caps, like you were saying earlier.
Yeah.
I mean,
I guess I was thinking,
excited is are there Web 2 companies or consumer-facing companies that were Jan, sorry to personalize it, has a mediocre customer experience now.
Yeah.
But by using better data,
yes,
would make me happier and a bigger consumer. And some of that depends on what we're willing to share.
Yeah.
Like, I go on Netflix,
yeah,
and it never feeds me the movies that I would really want to see, right? It just shows the top sellers. But I mean, I even in our personal productivity tools, you see AI coming down,
yeah,
right, and making it more applicable for travel and things like that. So, And the last area where I'm not a big consumer, thank God, is healthcare. But I mean, my God, the customer experience is so awful in healthcare, right? And there's so many inefficiencies there that I think would, and frankly, people don't consume enough of healthcare sometimes from a diagnostic perspective. So, sorry, I'm going to do a very quick sidebar. There's something called a calcium CT scan, and I don't know if you've ever heard of it, but it's not prescribed by your doctors, generally speaking. But what it does is measure calcium buildup in your veins. And a friend of mine basically lucked out and had one of those tests right before he was about to have a massive coronary event. And why are it's a $200 test. Like I asked my doctor about it, and goes like, I don't know. I don't normally prescribe that. I'm like, I just want to take it. My friend told me to take it. So that's my passing it on now, to get a calcium CT test.
I'm taking a note.
Anyone over 40 should have this.
Yeah.
And anyway, sorry, but that's a little bit on the side of maybe there's revenue opportunities in the healthcare system, right? If you start getting better experiences, because some of these things right now are just disappointing.
And then if you add quantum and drug discovery, then I feel like there's like a lot more use cases and optimization of this and that and logistics. Some of those go back to, reducing costs, but if you can give people a better experience.
Yeah. Well, I mean, so this kind of gets back to what you were saying, Jan, about small caps. So they might not have the budget to be big investors in AI, but they can certainly be big users of it, because personally, I use AI pretty much every day now, and I haven't spent a dime, but it certainly makes my personal output more efficient. And I'm a Gen Xer.
Well, you're contributing your data and your brilliant mind to the large language models that you're using.
That's true.
It's important because
it's good to know.
I make that point because it could be a winners take most, industry structure. Again, we invested in a startup that was financial use of AI. So it was supposed to be a Bloomberg killer, but they basically had to pivot because the models that get the more questions are the Perplexities and the ChatGPTs of the world. And their models will give better answers because they're getting more prompts. And so it's like, again, the winners, are the big firms. The traffic matters, the networking effects. In this case, it's large language model learning are those the scale winners.
You know that there's actually jobs for human beings to train these LLMs. So talk about a dynamic, flexible labor force. Like if you lose your job, you might actually be able to get back in a way you didn't expect.
We all work for the computers.
Yeah.
So that's fascinating. That kind of makes me think of like Tesla and all the miles that they're tracking, all the data that they've got for all the vehicles. Now, Waymo may have some advantages in terms of how long they've been doing autonomous, but you have all these vehicles, hundreds of thousands or millions of vehicles that are collecting all this data. And then how's that data used?
That's 100%. It's having scale data in a particular application area, right? And those are the winners.
Can I ask you a tech adjacent question? Because we've already hit on it. And again, you're among friends. So we've had some of your peers on the show, like Matt Hogan, the CIO at Bitwise, and Mike Green from Simplify, another one of your peers. But I wanted to kind of float his kind of explanation or description of Bitcoin and just see what you think of it or what you thought of it. When he was describing or kind of giving us his take on digital assets, we'll call them, he gave a very simple kind of Econ 101 explanation, which I thought was interesting. You get two of those and then you got me, like you got your hook in. So, but he was saying basically the way Bitcoin, we'll just use that as an example. It was designed, it's doing its job because it has, by design, mechanically finite supply. And so the distribution of outcomes have a positive skew. And as wealth managers, we like that. I don't care if some people call it speculative. If it has a fat right tail, I'm in. What do you think? Is that a ridiculous explanation?
I mean, you could look at it conceptually and then as sort of a financial asset and its behavior. Conceptually, VanEck started the first gold fund in 1968. We were the first ETF sponsor to file for a Bitcoin ETF in 2017. So, it's the similar thesis as gold. It's limited supply. Some people don't believe in it, because it doesn't generate economic value, interest, but it's got that scarcity component. So I think from a financial perspective, meaning the right tail, one of the things I think that's interesting to observe and has been holding back its Bitcoin's adoption to a certain extent is the fact that its correlation to the NASDAQ, let's call it, before 2020 was zero. And since the, kind of COVID crisis, it's been like 0.5. And so that makes it much less appealing. It makes it more of a risk-on asset, if you will. It makes it less appealing in terms of being portfolio additive or not. I would say that the one thing we're believers in Bitcoin. I think it'll get half to half the market cap of gold, so $400,000 a token. But we will also say there are times not to be invested. So if you believe in the 4-year halvening cycle, you want to be cutting back before you get into 2026. So we publish a lot of content in this area, and we have models that allocate in and out of Bitcoin. We're happily fully allocated now, and we don't want people not to invest because of what I just said. But there are times to lighten up. So and correlation is something to keep an eye on. I can't really explain why its correlation has crept up, but that we'll just have to see how that goes going forward.
And of course, I mean, we can't talk about tickers, but I think you've got probably the best acronym in the business. Hold on for dear life.
Hold on for dear life.
Yeah.
Yeah.
Look it up. You don't know what I'm talking about.
It's very crypto.
So Jan, I got a question about just kind of the Bitcoin and how you're looking at that. Do you foresee that with all of these ETFs that are out there and BlackRock has raised a whole bunch of assets, and at some point maybe Bitcoin or crypto is going to be in 401ks? Do you see that just being a huge tailwind that people should kind of just be a little bit careful of, because there could be some seasonality or times that, like you said, you may not want to own it? Does that kind of put pressure?
No, I mean, part of my thesis is like a child that's growing up, and it's certainly not reached full adulthood yet. So even in the wealth community, there are big wealth advisors, big banks, right, that still have not allowed their advisors to solicit investments in Bitcoin. So there's a long ways to go, I guess, to get to your.
Good point.
I mean, it's interesting that its drawdowns and volatility has been relatively lower. I mean, it's higher than the S&P, but still, it's really much lower than it has been in history. So that would fit this narrative of it's kind of maturing over time. The one thing I would say on the topic of crypto is VanEck is kind of generally of the belief that investors should use model portfolios or should use active management. And that's a little bit of a change for us. So starting in 2022, we launched 13 different token ETPs in Europe, single tokens. And, when we launched our Ethereum ETF last summer, I started asking people, I'm like, do you know what Ethereum's market share is? and no one knew the answer. And then I was like, you know what? Don't buy it if you don't know what's happening to their market share, right? Because if there's another protocol that's gaining in popularity, you don't know that, it's sort of like you're invested in a car company and there's another brand that's stealing market share. You have to know that. So we've launched an actively managed ETF, and I think that approach gives much more flexibility in the space to move around, the technologies. It's such an early stage kind of technology area. But I mean, I'm as much a believer in indices as the next ETF sponsor, but sometimes the market is just too hard for that to be the right way to go. But that's sort of what our philosophy is changing a little bit.
I love it. Well, we love active management too.
Like you, I've had the same bank account since my college days, and I haven't changed. But to your point, they haven't either. I tried to buy one of the larger recognized Bitcoin ETFs, and they rejected the trade in my IRA. They disallowed it. So we still have a long way to go there. It's amazing. Yeah. But I wanted to come back on, because I'm going to lead the witness a little bit, but on the sectors that U.S. investors might explore if they have an interest in exactly the things you're talking about, like gold and maybe a China play. How about, what are your thoughts on the U.S. materials sector?
Yeah, I mean, the materials sector, I mean, from my perspective, has been challenged for quite a while. And part of it is obviously you had the kind of economic activity slow down from COVID. You've had the China kind of readjustment, if you will, given their property bust. So there's been a lot less demand out of China on a global basis. But arguably, they've started to kind of shift, because now they are very much beneficiaries of this re-electrification or expansion of the grid and building. And I did talk about China before, but one of the things I didn't mention is there is a prospect also for more infrastructure in China. And you probably want to hit your head against a brick wall because how the hell could China need more infrastructure? But just like in the United States, infrastructure needs to be renewed. And a lot of the infrastructure in China in the early days was of lower quality. I mean, if you have a stainless steel and you don't put enough nickel in there, guess what? It's not stainless for very long, right? So there really is the potential for more of a driver there for the resources and material sectors. Absolutely. It's certainly something that you wouldn't want to be underweight, I would think, right?
Yeah, well, I agree with those thoughts. Dollar weakness helps. I was not expecting an artificial boost from the spike in copper prices, thanks to Trump's tariffs on copper imports. So we'll see how that evolves. But I guess another way to frame this discussion is in terms of style. So technology, that's very growthy. But I think it's kind of hard to make the case that materials is a growth strategy. I think a lot of those kind of old economy cyclicals are really still screening as value stocks. So where do you stand? Do you embrace one style over the other, or are you kind of agnostic when it comes to growth or value?
Getting back to this sort of macro perspective, my feeling is I look at all that stuff, but unless it's sort of at an extreme, I don't kind of have an opinion. So, again, last summer, growth against value was at an extreme. It was exactly where it was in 1999, large cap growth versus large cap value. And not only that, but S&P equal weight was as weak against S&P market cap as you've ever seen. So, those were the indicators to me last summer that growth had kind of, was just too extended. But, the great thing about growth is if you get that earnings growth, they catch up to valuations. And so I just don't see that much of a screaming differential between growth and value right now.
Interesting.
That's fair.
Could I go back to what we are talking about with infrastructure and Tally mentioned materials. So, you have a lot of developed countries that are trying to move away from fossil fuels and I feel like we're still going to be reliant on natural gas for a long, long time, maybe crude, not as much, but there's still countries like India and China that use a lot of coal just to, generate electricity. Do you think at some point, that kind of goes away? I know with solar and wind, these are not as efficient, certainly as nuclear, and natural gas kind of plays its role. But what do you think happens with coal?
I mean, yeah, it's part of the mix, and it is, to your point, because of its cost advantage. It's really hard to see it going away. I think where you're the optimist would say less of the mix going forward,
Yeah.
right? And then you would say cleaner coal. There's a lot of dirty coal in the world, so you would hope for cleaner coal. But the question is really what's going to happen in India and what's going to happen in Africa as those regions get wealthier. They're not going to decarbonize, that's for sure. So, and we can't tell them it's to not develop. So, to your point, I think the best you can hope for is just a better mix for the environment on the margin going forward. And, obviously, well, not obviously, but I'm very enthusiastic about nuclear, right? That's why we started our ETF a long time ago. And it's great that it's been a bipartisan change. It was really under Biden and the Inflation Reduction Act that Democratic governors from California, Michigan, and Delaware allowed for the extension of some nuclear plants and even allowed some new permitting. So it's great. It's just great for me to see that.
Yeah.
On a bipartisan basis. Bipartisan is just much more endurable, and for longer term investments, you need bipartisan support. You can't be flipping around every 4 years.
Yeah. That's so true. I feel like if we had more bipartisan things happening, that would just make the markets probably more calm too.
Well, so we talked about large over small, maybe a blend from a style perspective, international over domestic. I'm hearing also kind of a pro technology or tech enabled bias. I guess the only other question that our advisors might want to hear your answer to is where do you stand on the recession issue? Are we nearing one, or are we going to avoid it?
So to me, the overarching narrative is that the federal government has been spending a ton of money over the last 3 or 4 years. And so when the fiscal policy is 2 feet on the gas pedal, I think that really kind of explains everything. It explains why we didn't have a recession in 2022, 2023. So the question is, what's happening to fiscal policy now? And I guess I have this grid where I look at what do I think the fiscal deficit will be. I still think, so during the first 5 months where Trump has been in power, this is Piper Sandler research, the federal budget deficit has been running at 5.5% at GDP. That is definitely less than our last fiscal year of 2024, and it's a lot less than what CBO was scoring. Now, that includes some tariff revenue, not all of it, but some of it, and it doesn't include some of the government spending and tax goodies that Trump put in the big, beautiful bill. But if I'm right, okay, so if Jan says it's going to be 5.5%, let's just use that as a number, a little bit less, that would mean that it's going to be a slowing of the U.S. economy a little bit. Not necessarily a recession, but just a slowing. And I think that's fine. The issue that we have, I think, as trying to look at the markets is there's so many countervailing forces. It's really hard to say I can go risk on, risk off, or make any informed decision. Like, because even with inflation, right? Inflation should be coming down if the economy is slowing, yet immigration is slowing down. So there's going to be maybe more labor pressure. So there's literally, for every economic statistic, I can give you two sides of the coin. And so I'm just sort of saying, you know what, bigger picture, the economy should be slowing a little bit if the federal government is cutting back. And, you know, but I don't see anything dramatic there. The real question is going to be, are companies, you know, using technology to increase their earnings and their margins? That's what drives equities.
Thank you for that. Well, I don't know. I mean, Jim, it sounds like we have a lot of common ground with Jan. Is that a concern or is that a good thing? We agree too much.
No, it's good. It's good. Well, I was going to ask you too. So, Jan, you have a newer ETF, Buzz, that is looking at sentiment, and I'm curious, just kind of the construction of that, and I'm also curious, like, over time, as you use AI to maybe look at tweets or things, you know, where money flow is going, does that change at all? I'm just fascinated that I feel like even just a few years ago, you didn't have a lot of strategies that could even do that. It was, you know, I have computers that can listen to earnings conference calls, and then they were able to say, well, based on how the analyst asked the question, it sounds more bullish or bearish. So curious what the evolution of that is.
Well, let's look at the structure of the U.S. equity markets and research, right? Wall Street has cut back on its research budgets over the last 20 years, right? So there's not a lot there are fewer stocks that are covered, fewer analysts covering any particular stock. Then the question is, okay, is there value in all the commentary on Twitter and other social media about equities? And the thesis of the social sentiment ETF is that, yes, there is value in those signals, and it's rebalanced monthly. So it's a little bit more frequently than we would normally have for an ETF. And I certainly wouldn't make it your only equity allocation, but
Sure.
To your point, it does use AI to sort through all those social media posts, because, like, for example, what's a smiley face on an earnings call? Like, you know, there's a lot of assumptions and kind of intelligence that needs to go into the consumption of that. But it has caught, it's sort of almost like a hyper momentum ETF, and it's done it better than some famous managers in that space. So I would be remiss if I didn't do a shout out to our largest U.S. equity ETF, which uses Morningstar equity research. So Morningstar is known for ranking funds, but they actually have the largest independent equity research team in the U.S. And so that's headquartered out of Chicago as well. But we use that in a couple of our ETFs, leaving tickers aside, and love to have conversations about that. It looks at effectively the competitive moats around companies, right, and whether their profitability can be sustained. So anyway, so that's
perfect, because we are kind of on the same page, because we actually get research from Morningstar as well. Exactly. You know, I'm thinking of like the tortoise and the hare, right, portfolios that they run, and you know, we have data that we get through Morningstar Direct that looks at the moats and, you know, fair value, and so yeah. Interesting stuff.
That fair value methodology. So you take the set of companies maybe with a competitive advantage, right? And then you say, okay, relative to where we would expect the stock to trade, where is it trading? And that ends up adding a lot of the return to that fund. So it's not, yes, it helps to have companies with a competitive advantage, but it's even better if you can use some valuation mechanism to guide when you add and when you take it out of the portfolio.
100%. That's awesome. Tally, I don't think I have any other questions. This has been super helpful.
It's been
Jan?
great. Maybe one more question. I don't know if you bother targeting the S&P 500 or not. Even if you don't, it doesn't matter. But maybe for our advisors' sake, what do you think, Jan? Are U.S. stocks going up or down from here, and by how much would you say?
I mean, listen, I think no reason not to be invested. Equities are a great place to be. I can make up some reasons like valuations, but that's just not enough of an information signal to get out of the markets. So that's where we're at. We're fully invested.
That's great to hear. So again, we find ourselves agreeing. We don't lean on valuations too much because the R squared or coefficient of determination is basically zero between now and the next 5 years when it comes to, their predictive power for
it's
returns.
very bad for timing. Unfortunately, it's so commonsensical, but it's so bad for timing.
Doesn't work for timing it. Yeah, it's true.
But what you were saying earlier about investors being forced to eat their vegetables first for a change resonated, whether it's, Doge and fiscal austerity or the tariffs. But, what's kind of fueling our bullishness at WCG is the prospect of now potentially being able to enjoy our desserts, whether that's in the form of deregulation, because that really hasn't come online yet, right? Or even the net positive tailwind of the tax cuts. What do you think on that score?
I think that, I mean, like I say, our president is a man on a mission, and he has just got such an aggressive list of things that he wants to do. And here Congress is on recess, and he's like, okay, I can do trade deals while they're on recess. So that's when I'm going to do trade deals. I mean, he really wants to get something done every day. I don't think we've seen something like it. And he just doesn't know if he's going to win the midterms or not, right? So he can only kind of control what he can control right now. So I agree. I totally agree with you. I think we may not hear about Doge anymore because not just because of the tiff with Elon, but also even the worst government misspending didn't seem to resonate that much, right, with the American people. So I think it may happen. It just, we may not hear about it. But deregulation, I agree with you. I think there's more to come there. I mean, there's a lot happening, but I think there's more to come, and that is so growth stimulative.
Yep.
So yeah, maybe that'll be the fall music.
Well, I like the sound of that. Jan, I want to thank you for coming on. You're in. We're gonna have you again if you'd like to come on, and we'll keep you in the roster.
No, it's great. It's great being on. Thank you very much. It's an honor.
Hers and his, three's company too. Come and dance on our floor.